yet? Let's go across and put all those questions to Rajeev Malik of Macquarie, who's also joined in now. Markets are in fine fettle this morning. 5,020 on the Nifty, just below 17,000 on the Sensex again. Asian markets too seem to be breathing much easier than they were on Friday. Rajeev, morning. Thanks for joining in. Is everything okay? Because Friday people seem to have panicked a bit on Dubai, and there were talks that it's just the first and other sovereign defaults or crises will follow from countries like Vietnam, Greece, etc. Do you think those fears are overblown, or is it a rational fear?
Well, I think to a large extent they seem to be overblown. There'll always be pressure points in different parts of the world, and Dubai for the longest time has obviously been up there in terms of its iconic growth, no matter how it was being financed. I think the critical issue really is, the world today, or financial markets across different physical, political borders are like a teeter-totter, that any kind of pressure point in one place is quickly transmitted to other places, and asset classes, for a variety of reasons, including the dollar carry trade, are highly correlated. So any bad news tends to get exaggerated. But in many of these markets, certainly in Asia, where the growth profile is a lot better, this is nowhere, and I would again underline, nowhere close to the 97 pressure points we saw in Asia. To a large extent, given the kind of correction you've seen, it could be an opportunity to go in.
Rajeev, morning. Let's talk GDP then.
Morning.
What's your figure for this time?
We're at 6%. We know that industry has done remarkably well in the quarter, close to 9.5%. The swing factor really is going to come from agriculture. Now, I think this is where the analysts in some ways are scratching their heads, because the harvest actually only gets captured in the December number. What is going to happen this time around is some kind of an estimate for agriculture output from the sown area is going to get captured, which is why I suspect, analysts are not perhaps factoring in large enough hit on the agriculture side, which should come through. Having said that, it is not going to change the broader trajectory. I would again re-emphasize growth is likely to pick up from the March quarter, and we would be hitting closer to 8% growth for next fiscal year.
6% would, though, be mildly lower than the previous quarter, Rajeev. Just agri, that's a problem for you, or any hiccups in services, etc. as well?
Services really at the margin. Don't forget the prior quarter was 6.1. So, that difference is not even, quite frankly, and I would confess, my margin of error on any forecast. What is important is that industry is recovering pretty handsomely, and that recovery is broadening out, while still supported by a heavy dose on the policy stimulus side. But nevertheless, it is beginning to broaden out and improve, and that's really the best possible news that Indian growth could really deal with.
This GDP number today is backward-looking data, Rajeev. If indeed this is 6% and the first quarter was 6.1, do you think the current quarter which we are sitting in and the next one will both be 7% plus, which will drag the overall number to 6.5%?
No, I think the December quarter should be actually even lower on a year-on-year basis, because don't forget that's when the actual impact of the fall in agriculture output will get captured. And while industry will do slightly better, services will do slightly better, at the margin we will still see a slightly softer number. The big kicker actually comes in the March quarter, where a combination of last year's weak base effect, broader improvement both on the agri side and on the industry side, all of them, and including services, it's going to be literally a triple engine playing in the March quarter.
The Dubai problem sprung up on us only on Friday, Rajeev. The other problem people have been tackling is the dollar and the dollar index in 2010. What's your call there?
We still see that the U.S. needs a weak or a weaker dollar. And that is simply, if you see how extended the U.S. households still are, it's unlikely that the Fed is going to tighten policy anytime soon. The critical issue is really, from a dollar's perspective, is going to be when some of the liquidity supports begin to get withdrawn. But, for the Fed to really start doing on that front, you at least need to see several months of improving data as far as the U.S. itself is concerned. And that doesn't seem to be happening right away. So my sense is the broader story will still remain. You go through these risk aversion bouts that really don't last very long. And yes, sometime in the first half next year, all of it might just end in tears. But for the time being, we're just benefiting from the broader policy that the U.S. itself needs.
Before Dubai came to the scene, there was one other wrinkle for markets even out here, and that was the prospect of tightening in China. And we heard a few voices from the Chinese government as well. Do you see that as a potential threat at all, which might derail the party that we are having at this point?
Not really. One of the things that I think markets or investors in general seem to be overlooking is that policymakers do learn from mistakes. And I think policymakers globally have learned something from the Japanese experience and from the 1930s. And I would be very, very surprised if anyone is necessarily going to jump the gun and be too aggressive about either tightening or withdrawing the stimulus, simply because, they've literally come back after staring death in the face. And I don't think anyone would have the gumption to necessarily be premature in any of those factors. So it's still going to be a relatively accommodative policy. Generally speaking, there will be some exceptions here or there, but the broader approach is still going to be far more growth supportive rather than all of a sudden all of us becoming inflation hawks.
Just for today, Rajeev, would you be worried if you saw a sub 6% number on the GDP figure, or would you treat it as a backward-looking figure and just that?
GDP reports all over the world tend to be backward-looking. It's just that some of the profile in emerging markets, the details only come out with the GDP details. For example, aggregate number for services sector. So even if it is slightly sub-%, I'm not going to lose sleep over it because the broader cycle is, gaining more traction and strength.
What could be the party pooper, Rajeev? Anyway, you're clearly bullish on Indian economic growth and bullish on emerging market economies generally. But going into 2010, if there's one fear that you have of something going wrong in the system once again, what is that?
Fiscal. India is only going to be top three things that would matter, and they're going to be fiscal, fiscal, and fiscal. I think 2010 is really the year when the government has to stand up and start delivering, and they have no choice but to start cutting that fiscal deficit and to step up on fiscal consolidation. Now, India's fiscal problems are not going to get fixed in 1 or 2 years, but I think there is considerable scope and I think conviction on part of the government and policymakers to at least start going that way. Over the next couple of years, there's a fair amount of significant fiscal reforms in the pipeline. Let's see what the implementation schedule is like. But next year's budget, I think the government has to just come out and send across a very clear-cut message that we are beginning to consolidate our fiscal finances, simply because if they don't do that, the investment cycle is not going to be as strong as we think it needs to be.
Thanks, Rajeev, as always, for stopping by and speaking with us. That's the view from Macquarie. 6% is their figure for today on GDP.